Don't you hate it when that happens to you? When it does, you need this and this and this. When it happens to me, I always know where to go. When you've got professionals on your side, your problems don't stand a chance. What are you waiting for? Contact them today and let them take care of your problems.
Welcome to Independent Wealth Planner Strategies with Jennifer Lang, helping pre-retirees and retirees build, preserve, and protect their financial assets in today's volatile market.
Sponsored by WFGInsuranceQuotes.com.
Welcome to today's webinar. I'm Mike Payne, and your host for today is Jennifer Lang. Jennifer is an author, a speaker, and a licensed financial services professional who found her love for financial literacy the hard way. Her career goals were on track as she tackled the hustle and bustle of working in New York City as a corporate manager. That is, until life threw her a curveball that would change her direction. Her mother became ill, and Jennifer only had one choice: She left New York and became her mother's full-time caregiver. It was during this 10-year period that Jennifer learned firsthand the importance of how life insurance protects an individual and a family while they are alive, as well as how having essential estate planning documents can empower family members and relieve burdens. She found a new passion and purpose to help the underserved middle class protect against the emotional, physical, and financial stresses of caring for their loved ones. Currently, she works with businesses and families in all 50 states to acquire business loans, life insurance, and annuities. She is contracted through One Resource Group, and you can contact her through her website, wfginsurancequotes.com. So, without further ado, Jennifer, take it away.
Thanks, Mike. I'd like to welcome and thank everyone for attending today. My name's Jennifer Lang, and this webinar is being recorded and will be available for rebroadcast later on. So please submit all questions via our website, jenniferlangfinancialservices.com. And the chat is open, so tell me your name and where you're from, and I'll get to questions as time allows. I see some names in the chat box already. Hi, Deborah from Texas. Good to see you. Pam from Virginia. Good to see you too. I see Marcus from Georgia. Glad you made it. Awesome. Well, thank all of you for joining. Today's webinar is entitled Better Than Bonds and CDs. Here's a look at fixed indexed annuities. And as Mike mentioned, a person can either learn things the easy way or they can learn things the hard way. And in my case, when my mom got sick, I learned the hard way. I, like most people, thought that life insurance was just something you had in order to pay for a funeral. I didn't know that there were certain policies that could actually help you while you're alive. So I do these webinars and I speak to businesses and organizations because I want to help as many people as I can reach their hopes and dreams and avoid that financial learning curve that I went through. And as a token of my appreciation, everyone on the webinar today will be given access to a free ebook that you can download after the call. So let's jump in. We did a survey and we asked consumers to create the ideal financial product to help them during retirement. What kinds of things might they ask for? These were our responses. I want guaranteed income every month, like a pension. I don't want to run out of money, even if I live until the age of 100. I don't want to lose any money. Period. I want to get everything out that I put in. I don't want to lose money when the stock market takes a dive. I don't want to miss out on gains when the stock market is doing well. If I die before retirement, I want to be able to pass money on to my kids, grandkids, favorite charity, etc. I want access to some or all of that money in case something bad happens. And without their knowing, they actually described an indexed annuity. So let's talk about what a fixed annuity is and how they work. If you're looking for safer financial instruments other than the stock market gamble, a fixed index annuity may be of interest to you. Fixed index annuities allow you to keep your hard-earned money protected while enjoying tax-deferred equity index-linked asset growth potential. With a fixed index annuity, you'll have the ability to take advantage of index performance-tied growth, retain your money growth, avoid risky assets in volatile investments like stocks, and prepare for a financially confident future. So let's start with the basics. A fixed annuity is an interest-paying contract issued by an insurance company. The categories of annuities can be either deferred or immediate. Like other annuities, a fixed index annuity is an insurance contract you own. It's a fixed annuity which earns interest or provides benefits linked to the performance of an equity index. Examples of indexes are the S&P 500, the NASDAQ, or the Dow Jones Industrial. To be clear, fixed index annuities do not directly participate in any financial markets. The value of the index may be tied to a stock index or another index. When the index records positive change, interest is credited to your annuity's value. This interest rate is calculated using a formula based on equity index changes. It also comes with a minimum guaranteed interest rate, so your principal stays protected in the event of negative index changes. To recap, a fixed index annuity is a contract between you and an insurance company. You pay premiums and the issuer promises to make periodic payments to you in the future. Premium payments can be made in one lump sum or in installments over time. Now, one of the biggest myths about fixed index annuities is that you can compare them to the stock market, when in reality, despite the temptation, comparing these two investments is not an apples to apples exercise. It's more like apples to oranges. Fixed index annuities don't actually participate in the stock market as, say, a mutual fund would. By definition, a fixed index annuity provides principal protection in a down market and some opportunity for growth, something the stock market isn't designed to provide. The interest a fixed index annuity earns does not come directly from the stock market. Instead, fixed index annuities credit interest based on the movements of a key stock market index, such as the S&P 500, excluding stock market dividends. So to be clear, a fixed index annuity does not include dividends that you might otherwise earn from equity market investments. But this also means that your money inside a fixed index annuity will never be exposed to stock market risk. The trade-off of less growth potential in exchange for principal protection is one of the hallmark features of a fixed index annuity. For those of you who have not heard of Dr. David Fowl, he is a professor of retirement income at the American College, and he recently published a white paper entitled Managing Risk with Fixed Index Annuities in the Pre-Retirement Years. In it, he reports that fixed index annuities are, and I quote, another option for pre-retirees to consider that provide structured returns to better manage downside risks, end quote. According to Dr. Fowl, fixed index annuities can also, and I quote, function as an asset class within an accumulation portfolio to better manage downside risks while still allowing for participation in the market upside. The ability to better manage downside risks can lay a foundation to either reduce the asset level necessary to successfully retire or to enhance the returns produced by a given asset base, end quote. Now, for anyone who hasn't read this report, it is excellent. And if you would like a copy of Dr. Fowl's white paper, you can contact me and request a copy via my website, JenniferLangFinancialServices.com. But it is excellent. The following video discusses a couple of scenarios to see how long your money will last in retirement.
Remember 2008? Sure you do. That was the year of the financial crisis, when the stock market lost nearly 40% of its value and shrank the assets that millions of baby boomers were counting on to fund their retirement. Of course, the markets rebounded, so no worries, right? Right? Well, it's true that during the years you're saving for retirement, if the market drops, you may have time to rebuild your assets that are subject to market volatility. But once you start withdrawing your money, that's when market volatility can have a big impact on how long your assets will last and how comfortable you can live in retirement. One factor in how big an impact is your sequence of returns. That's the year-by-year returns that your retirement assets continue to experience while you're drawing on them for retirement income. Here are a couple of examples. Say you're retiring with a nest egg of $1 million and you plan to withdraw $50,000 per year with a slight increase every year for inflation. Meanwhile, your remaining asset is still invested and still subject to the ups and downs of the market. Of course, we can't predict those ups and downs, your sequence of returns, but let's say that in your first year of retirement, you get a really good return. And the next year, you get another positive return. Not as good as your first year, but still positive. Then in year 3, well, a little less. And in year 4, ouch, the market drops and you take a loss. Now, with compounding, you'll average a good positive return over those 4 years. And that's what you want, right? So let's keep repeating that sequence of returns in the exact same order until your annual withdrawals have completely used up the asset. In this example, that's 38 years of income. But what would have happened if you had started withdrawing money in a down market? To find out, let's take those same 4 numbers, and this time we'll reverse the order. You still get the same compounded average, but this time you're starting out with a significant loss, then an okay gain, then a better gain, and then a really good gain. And as before, we'll keep repeating that sequence until your annual withdrawals have completely used up the asset. But in this example, it happens about 13 years sooner. You'd have lost 13 years of income, and only because you got the same returns in a different order. Of course, there's no way to predict the order of your returns, or whether it will be an up market, a down market, or a flat market when you start your retirement. However, there are potential retirement income solutions, like an annuity, that can provide protection against losses due to market volatility. An annuity can also be a source of guaranteed income for your retirement years. Remember, every additional year your assets last can mean fewer financial worries and a level of comfort. Yes, a long retirement is good, but it's even better when you have the money to enjoy it.
Investing directly in the market exposes investors to both volatility and market risk. This uncertainty can make it difficult to create a reliable retirement income plan. Fixed index annuities, which track market indexes but aren't invested directly in the market, allow for some exposure to market gains while avoiding market downside. A fixed index annuity allows you to grow your money when markets are up and lock in gains when they decline. Upside potential is offered through the opportunity to earn interest credits linked in part to the performance of an external market index. The annuity's value can grow when markets rise. When markets decline, guarantees in the annuity provide protection from loss. While it's possible to earn 0% interest in any given interest crediting period, you can never earn less than 0. In addition, the interest you earn is locked in and cannot be lost, even if the market goes down. This graph demonstrates how the S&P 500's historical performance over 10 years compares against growth of a fixed index annuity that tracks the same index. Though the amount of interest you can earn with the fixed index annuity will typically fluctuate depending on the specific terms of the annuity contract, performance is more stable than in the underlying index. This stability provides an opportunity to pursue growth without risk of loss due to market downturns. Another thing this graph shows is how premium that is allocated to one of the index strategies will receive interest that is calculated in reference to the upward movement. Now, here comes the disclaimer. This is a hypothetical example and is for informational purposes only. It is not indicative of past performance, nor is it intended to predict future performance of any specific product, including an annuity, nor is it intended to represent any particular product or interest crediting method. The graph is demonstrating annual cap limits of interest credits to 4% each term. But the main takeaway is that with a fixed index annuity, your gains are locked in and losses never eat away at your principal. This next video looks at how healthcare, inflation, and taxes can affect your retirement nest egg.
How much retirement income will you need? Allianz answers. So your retirement is finally on the horizon, and you're getting ready to turn your retirement savings into an income stream that can help pay for your housing and food costs, healthcare, and other expenses like entertainment and travel, so you can count on the same amount of income year after year for the rest of your life. Sounds great, right? But what happens if your income takes a hit? That stands for healthcare, inflation, and taxes, and there's 3 big reasons why your retirement income may not go as far as you think over time. Here's why. We know that as people get older, their healthcare needs increase. And what's more, the cost of medical care has risen, a nearly 75% increase during the last decade alone. But the rising cost of healthcare isn't all you have to worry about. Because historically, the general inflation rate for goods and services has been about 3% per year. That may not seem like much, but years of inflation can significantly lower your purchasing power. How significantly? Well, if you had received the same amount of income every year for the last 25 years, today, that income would buy only half of what it used to. And on top of that, there's also the possibility of higher taxes in the future. And not just higher federal taxes, but higher state and local taxes too. So while we can't know exactly how much income you'll need in retirement, we can tell you this. Even if you're starting with what seems like a substantial annual income, these unpredictable rising costs, the hit, could quickly chip away your purchasing power and lower your standard of living. That's why, to help with your plans for a comfortable retirement, you may want to consider a solution like an annuity. Annuities are designed to meet long-term needs for retirement income. They provide tax-deferred growth potential, a death benefit for beneficiaries during the accumulation phase, and a guaranteed stream of income during retirement. But it can also have the potential to increase your income when your annuity has an income benefit such as an optional income rider that may have an additional cost. Yes, it's important to plan for enough income at the time you retire, but an annuity with increasing income potential can help offset rising expenses later. So, if the hit comes, you're more ready for it.
When we opened up, we went over the results of our survey and discussed what benefits consumers are looking for in retirement. We then looked at other no market risk ways to protect retirement principal. Right now, the best CD rates are 2.25% to 2.70% for up to 2 years, according to Bank Rate. But these rates are offered through online banks or online-only offers from chains like Capital One. If you visit your local bank, you're probably going to get a lower rate. For example, as of July 2019, Bank of America's standard term CD rates were 0.03% to 0.75% annual percentage yield, depending on term and balance. Yikes. The best online savings account rates are 2% to 2.39%, according to Bank Rate. Those percentages are also for online banks or online-only offers. As for local banks, as of this airing, Wells Fargo offers a platinum savings account with 0.05% annual percentage yield. U.S. Treasury bonds are 2.53% as of July 2019, according to Treasury Direct. The S&P 500 return rate from January 1st, 2000 to December 31st, 2018 had a 2.85% annualized return, according to MoneyChamp's Compound Annual Growth Rate Calculator. According to this calculator, if you'd started on January 1st, 2000 with $1 in the S&P 500, you would have had $1.71 on December 31st, 2018. When we compare the rates listed to the fixed annuity average rate of 3.29%, suddenly fixed annuities are quite competitive, especially when you include the other benefits they provide. Let's look at both sides. Has a certificate of deposit or savings account ever provided guaranteed income you can't outlive? Has the stock market ever provided a written guarantee against loss? These are some of the realistic options for preserving your principal. And even with today's historically low interest rates, annuities can figure into a huge part of the equation. This final video looks at the realities of retirement.
How well can I live on a fixed income during retirement? Allianz answers. When you plan for retirement, you're really deciding how much money you'll need for the rest of your life. Most people talk about living on a fixed income that includes Social Security because they're guaranteed to receive that income through retirement. And to supplement that, many people add savings of their own because Social Security may not cover all their wants and needs, and its future is uncertain. Now, you may be thinking, it seems like a good amount of money now. What's wrong with having a fixed income? A fixed income is fine, as long as your expenses are fixed too. And considering the overall trends in inflation, the money you save today could lose value over time, and that might impact your purchasing power in ways you hadn't planned. Say you're retired and you have a fixed income. For now, it covers the things you have to spend money on, like housing, food, fuel, and healthcare costs, as well as the things you want to spend your money on, like a night at the movies, a trip to the mall, or a special occasion. That'll be the case for a while, but as the years go on, you can bet your costs will go up, and meanwhile, your fixed income is, well, fixed. So then what do you do? Well, you can't avoid your medical bills, your housing costs aren't going away, and there's only so much you can cut from your food budget. So you end up having to hold back on the things you really enjoy, like trying a new restaurant you've been meaning to visit, or a weekend out of town. And what about your grandkids' birthday gifts? Sounds a lot less fun, doesn't it? If you're relying on sources that offer limited ways to increase income, there could be some tough decisions ahead. That's why you may want to supplement your retirement savings with another source, such as an annuity that provides the potential for your retirement income to increase through an income benefit. And while Social Security may offer a cost of living adjustment that can help address the effects of inflation, having an annuity that provides the opportunity for increasing income lets you do more with your savings, so you can still afford the things you have to spend money on for as long as you live. And when that income has the potential for annual increases, it's a way to maintain the standard of living you want to have in retirement, so you can spend your money on the things you really care about. That's the way it should be.
Moving your life savings from one account to another is a huge event. You need to make sure you have a trusted advisor or agent to help you. A great agent will walk you through the entire process. Our agents have helped hundreds of individuals move their retirement savings into the safety and security of a fixed annuity. Contact us if you're recently retired or have stopped contributing to your retirement savings account. We can show you your options to ensure that your retirement is as hassle-free and predictable as possible. All right, well, unfortunately, I'm limited by time. And as a token of my appreciation, everyone on the call will have access to a free ebook from SafeMoney.com entitled The Retirement Report. This way, you'll be able to grab a hold of things I wasn't able to cover in this episode. Simply go to my website, JenniferLangFinancialServices.com, and click on the ebook section. We actually have 3 books available right now. Feel free to download whatever booklet interests you. I've been getting a lot of positive feedback about the 3 booklets. And since I'm a member of SafeMoney.com, there's never a cost to you. Just let them know I referred you. So where it says enter the name of the referring advisor, just type in Jennifer Lang and you can get the book for free. Also, you'll be able to view articles and learn more about life insurance and retirement planning from my site. We have loads of information and content available for free, which will not only help to increase your knowledge base, but save you a lot of time. And of course, if you have any questions or would like to have a free financial needs analysis done, contact me via my website, jenniferlangfinancialservices.com, and I'll get your questions answered as soon as possible. Thank everyone for attending and have a great day. Until next time. Have you ever walked into a store and had a salesperson try to sell you something that didn't quite fit? Just because that's what they had in stock. Well, when you buy life insurance directly from an insurance company or from an agent who only represents one company, you can only get what they have to offer. You're buying life insurance right off the rack. Here's a better idea. Contact jenniferlangfinancialservices.com. We're an independent agency and we represent many insurance companies, so we can find life insurance that is the right fit for you and at a price that fits you too. Log on to jenniferlangfinancialservices.com. At jenniferlangfinancialservices.com, we find great insurance quotes.